Hello, good evening again. Smart Money Traders, this is Rambo KE again. So, as I say the earlier, we are looking at Forex market, and we had already started discussing the institutional reference points of the smart money that they mostly tend to use in the market. Alright, they don't do this intentionally, guys. Just a footprint that shows up in the market. Alright, so it's due to our advantage to use them in identifying and taking our trades effectively so that our analysis may be in a better position. Alright, trading is all about guessing, right? But when you guess, you want to make sure you are making an intelligent guess so that your guess can have a higher probability of getting it right. Alright, so without wastage of time, the previous video I looked at the mitigation block and I found out that mitigation block we have two types, that's a bullish and a bearish, and in a mitigation block we have something that's called a failure swing. Alright, that's the only thing that differentiates a mitigation block. That's the only thing that differentiates an mitigation block and this breaker block. Alright, so today I'm looking at a breaker block. Now what's a breaker block? Breaker block is an institutional reference point. Alright, we have 7 of them. We have looked at another block, mitigation block, and now we are looking at a breaker block. Then later we look at a liquidity void, henceforth and henceforth. So breaker block, as from the name breaker, it breaks. Alright, so where does it break? It breaks above. Alright, it breaks above and below for us to establish that we have a breaker block. Alright, so as a mitigation block, this is what I found out. Let me sketch a mitigation block here. That we have price moving in this manner in an uptrend. It creates this failure swing, right? It doesn't take the previous higher high, alright? It creates this failure swing, then also breaks below the previous higher low, alright? Crosses below this point. Want to see price retracing into that, then we will take ourselves the downside. Alright, this is a bearish mitigation block. Alright, this was moving an uptrend. This was the last higher high, last higher low. From till higher low, we expect price to push up, create a new high, but price failed. Alright, you can see at this point, price failed. That's why it's called a failure swing, because it failed to break the previous high and form a new high. Alright, just failed, and then instead we had this aggressive momentum, heavy momentum, breaking the previous higher low, right, and closing below. So we are called this a market structure shift. Alright, and all we wanna do is to wait price to retrace back up to our last sell candle. Alright, let's look at that point. We take our sell candle market and take our sell from the last sell candle. Alright, the last sell candle at this point is our bearish mitigation block. We take our sell from there. Our stop loss a little bit above the failure swing. Alright, this is about the bearish mitigation block. Right, so how about a bullish mitigation block? In a bullish mitigation block, this is it. Price is moving. Alright, moving. Price is moving. It didn't break below. It created a failure swing, and then we see momentum breaking above. Want it to retrace up to this point, and then we take our trade to the upside. Alright, because it's a bullish mitigation block. So our last buy candle at this point becomes our bullish mitigation block. Our stop loss below the various swing around this area, and I'll take profit at the adjacent liquidity. As simple as that. That's how we can use our mitigation block in taking our trades. So how about a breaker broke? How can we identify our breaker broke? I don't want this video to be long like the mitigation block was, so I want to make it short, very short. So we have also two types of breaker blocks. We have bearish breaker block, as you can see here, bearish breaker block and bullish breaker blocks. Alright, so let's start the bearish breaker block. The name comes from the action price takes when it has hit our breaker block, right? The name is not so very important as long as you understand what's happening in the market and how you can trace that in taking the trades. So in an uptrend, we said we want to see a series of high highs, alright? Higher low, higher high, higher low, higher high, higher low. So this was our last higher low, alright? Notice what happened. Price came and took our previous high, alright? Created a new high. In the mitigation block, remember we didn't see this price breaking above the previous high. We saw price having difficulty in breaking the previous higher low, hence creating a various swing. But in this case, the breaker broke. The breaker breaks above the previous high, and then from there, we expected this price to come to the previous higher low, and then we should continue upward, alright, to create a new high. But instead, price took the previous high and then came and crashed below the previous higher low, right? I'm gonna repeat that. In an uptrend, we have price creating high, higher low, higher high, higher low, higher high, and higher low. This was our last higher low. Then from this our last higher low, we are expecting price to break above and create a higher high. Then we will continue in an uptrend. And price did so, came and broke the previous high, created a new high. From the new high, we're expecting price to come to the previous higher low. It came to the previous higher low. Then from here we're expecting price to push above for it to continue an uptrend, but instead price broke below the previous higher low, right? Creating what we call a market structure shift, right? The market created a bearish market structure shift. So where can we mark our breaker block? We take our last side candle because that's because this is a bearish breaker block. We take our last side candle at this point, mark it right up to that level, just like we marked the mitigation block, and then we'll take our entry from the last side candle, right? Now that is our bearish breaker block, right? We said I will take ourselves from it to the downside, alright? So the only difference between the mitigation block and the breaker block is that the mitigation block creates a various swing at this point, right? It does not take the previous high, it just creates a various swing and then crashes down. But in a breaker block, the breaker breaks above, alright, the previous high and it breaks below the previous higher low, right, creating a market structure, and that will be our bearish breaker block. Alright, that's the only difference between a breaker block and the mitigation block. Now, how about the bullish breaker block? The bullish breaker block is often found in a downtrend. The market is creating a series of higher low and high highs, higher low, high high, higher low, high high, higher low, high high. And then from this point, we're expecting price to create a higher low, then come to higher low and then continue creating a lower lows, but instead this was our last lower low, right? At this point price came, created high, price came, crashed down, took the previous lower low, right, and then crashed above and violated our last higher low at this point and created the market structure shift. Now we take our, that's because this is a bullish breaker broke, we take our last bullish candle, right? At this point where the market structure shift was formed, we mark it and we take our trade from the last bullish candle, right? Now this time round we put our stop loss below the new lower low, right, that was broke below, and our take profit at the adjacent, right? Simple as that, that's how we take our trade, right? So this, we can call this a liquidity grab, right? So a breaker broke usually takes liquidity above and below before changing direction, right? A mitigation broke does not take liquidity, it just creates a failure swing before it gives us our mitigation broke. But a breaker broke usually breaks above, taking liquidity, and then from there you can see price gaining momentum and breaking below, giving us our breaker broke. Here we should take our trades from. So there's a few things we need to note when it comes to breaker broke and the mitigation broke before we continue to another institutional reference point, right? I've tried to write them here, right? Just a few need to note before we continue. And our first one, right? Let me make this more transparent. No, come on. So that we can, perfect. So it's a few things we need to note here, alright? That in a mitigation block and a breaker block, we will see a market structure shift, either in a bullish movement or a bearish, right? We need to see this market structure shift, both in a breaker block and a mitigation block. It does not usually happen, but 80% of the time we need to see a market structure shift, and then from there I can conclude this our breaker block or this our mitigation block, right? Unless it's in a continuation market, right? That's the only place when you are trading continuation. At that point we may not see a market structure shift, but when the price is changing direction, when you have to see this market structure shift to confirm to us that now we are in the right direction. And then second, we don't just activate our trade without waiting for a retracement. We wait for a retracement. Which retracement I'm talking about? This retracement, right? Price broke up to this level. We don't take trade from this level to the downside. We wait for it to retrace back, right, to our previous higher low that was broken, and then from there we can take our trade, right? So the same case here. Price came up to this level, creating lower low, then broke above. We don't just take our buy from here, we wait for it to retrace back to our breaker broke, and then we can take our trade, right? So we wait for a retracement. And then third, the only difference we have is that the mitigation block has a failure swing. We have talked about that. And the breaker broke breaks above or below, right? It takes liquidity in both sides, above and below, and then we can confirm our breaker broke and enter our trade. So let me try to identify 1, 2 on the chart so that these things can stick. Alright. Without going too further, I can see something like a breaker block here. Let me try to sketch it. Notice price was coming. This is a downtrend. You can see it with naked eyes, right? And then boom, then bam, then boom, then right? So let's try to be more specific in this one. Price was coming, created, lower low, retraced, higher low, lower low, higher low, lower low, higher low. Alright, so notice what happened here. This was our last lower low that was created. Price came, created higher low, then it came down, took this low, alright, having our break of structure to the downside, break of structure, and then from there price retraced, creating higher low, right, and then broke below the previous lower low, creating a new lower low. So up to this point we don't know what's happening in the market, we don't know what's happening in the market, so we just mark this as our break of structure. Alright, break of structure, price this our higher low, this our new lower low. But now notice what happened from this point, right? Notice what happened from this new lower low that was created. Price moved up aggressively with momentum and broke above our previous higher low, right? Remember this was our higher low. If we can mark it up to this level, we can see price broke above it. Now we call that as our market structure shift. Alright, market structure shift. Now up to this point, we have had our two conditions have been fulfilled. We have had price breaking below the last lower low, alright, and then from there we have had price gaining momentum and breaking above our previous higher low, right, up to this point. So we can call this a liquidity sweep. Price took liquidity because it broke below and went above, and then from here now we can have this retracement. We are seeing this retracement coming in, right, up to this level. So we take our last red candle, our last buy candle, because this is a bullish breaker broke. We take our last sell candle, alright, we mark it up to that point. Not sell candle, I mean our last buy candle. It's a bullish breaker broke, so we take our last bullish candle, mark it up to that point, and we only do wait for a retracement to come in, right? Why is the retracement? This is the retracement that we talked about to wait for, right? You can see it here. So we wait for price to retrace back to our last buy candle that was traded above, alright, we wait for retracement to it, then we take our trade from it, alright, our stop loss below just the newly formed lower low, right, just a little bit below the newly formed lower low, and I will take profit at the adjacent liquidity. Alright, as simple is that. So why is our breaker broke? Our bullish breaker broke is our last buy candle that was traded through with this aggressive move that we had already created a new lower low, right? So breaker broke takes liquidity below, took liquidity below this previous lower low and took liquidity below above the previous higher low and closes above, and then we wait price to retrace a little bit up to our last buy candle, alright, that was traded above, and then we activate our trade from there, right? That's how a bullish breaker broke looks like. I'm seeing a bearish mitigation block here. I'm just trying to sketch it very fast. Price was coming. This mitigation block up to this level, came, pushed, then look at what happened. Then price came up to this level, alright. So what can we say happened here? So we have this our last as our mitigation block. Now we take our trade from mitigation block, right? Stop loss just above the previous swing, and just like that, price delivered nicely, right? Just went on and on and on. So our stop loss should be placed a little bit above our failure swing, right? This is a failure swing. Let me remove this one so that it doesn't confuse us, right? This candle did not take above this high, right? So this is our failures swing, right? It failed to take out this high. Instead, it crashed down and taking this previous higher low, right? So that's how we can identify our bearish mitigation block, right? Can I see another one here very quickly? Yes, this is the last one I'm talking about. Now we have this bullish breaker. Price was coming to this point, went up, created a new higher low, then crashed, new lower low, right? Because we have evidently taken out this new lower low, right? Taking liquidity, and then from there we have seen price gaining momentum and taking above this higher low, creating a market structure shift. Then we wait for this retracement back to our last buy candle, right? That was traded above. Then from here we can activate our trade, right? If you can remember, this is the same sketch that we drew, right? Then we said we wait price to come to our last buy candle at this point, right? That's because this is a bullish breaker. If it was a bearish breaker, we wait price to come to our last bearish candle, right? And then we said we put our stop loss just below the new reformed low. Then our take profit the adjacent liquidity, right? That's the same thing that we will do here at our chart, right? That's the same thing that we will do, right? So we have seen that price came up to this point, pushed above, then came, then we have price taking out this was our last lower low, price came and took it. That's grab of liquidity, and then from here you can see price moving up, alright, moved up and violated our last higher low, creating market structure shift at that point, feel clearly. Then we said we mark our last buy candle, alright, in that movement. Our last buy candle, it was that one. We mark it from the tail, we mark everything from the tail, including the body, everything, and then we take our trade from the candle, right? Stop loss below from the no row, then I will take profit at the adjacent, right? And price delivered nicely, alright? You can take our profit up to this level, or even up to that level. On the price we're gonna trade up to that, take profit, right? You can see how price moved, though it had some struggles around this point, but eventually price moved up to take profit. So that's it for the breaker block. Our next video will be about liquidity void. The next video will be about liquidity void. We have not looked at the bearish breaker. I've seen one here. Let's look about it very fast. Not liquidity void, but bearish breaker. Alright, price was coming, then went above, then crashed, and then it traced back, and that's how we took this trade. Very powerful one, right? You can see this sketch. It may not be perfect at this sketch, right? But it's the same, right? You can see it, and we said we take our last sell candle because now this is a bearish breaker. We take our last sell candle, we mark it, and we wait for this retracement to come up to it. Then we take our trade to the bearish side. Alright, I want to take it here. Right, we have seen this price taking out this. This was our last higher high. It's in an uptrend. You can see it from this point uptrend. This was a higher high. This point to this point. Right, price took it, and that was our liquidity. Right, and then created bearish market structure shift. This point, right, you can see it very clearly. Right, that was our market structure shift, and then now we wait this retracement to come after we have marked our last sell candle, this black one, mark it up to this level. Right, now we wait this retracement to come up to it, then we can activate our trade to the downside. Since this is a bearish breaker broke, we can activate our trade to the bearish. Our stop loss just a little bit above our newly formed high, right? And that's how we get to catch such a wonderful trade. So that's it for now. Till the next time.